Hi there, I'm Jennifer Lee, Senior Economist at BMO Capital Markets. Well, it has been a very interesting month for North American financial markets. The Canadian economy, after starting the year off on a very strong note, looks like it probably contracted in the second quarter. Now, this comes after wildfires tore through parts of northern Alberta and slashed oil production by about 25% for the month of May alone. Now, this is temporary, and we are expecting a rebound. But it looks like real GDP likely contracted by about a 1% annual rate in Q2 before rebounding by about 4% in the third quarter, and that's being supported by rebuilding efforts, oil production resuming, and some pre-planned fiscal measures that were already in the works. Now, this, of course, doesn't even speak to the personal losses by the people in Fort McMurray and the potential job losses in the energy sector. But with that in mind, the Bank of Canada in May stayed on hold at 0.5%, and that came to the surprise of no one. The press release was as neutral as it could possibly be. It spoke about global economic conditions evolving roughly in line with what the bank was expecting back in April. The U.S. economy seems to be poised for solid growth in 2016. Financial conditions remain very accommodative, and oil prices are continuing to head higher, although some of that is due to some short-term supply disruptions. At the same time, the bank warned about Canadian growth remaining very uneven. So with that in mind, we continue to stick to our view that the Bank of Canada will stay on hold for the remainder of this year, with rate hikes likely not coming into view until the midway mark of 2017. Now, in the U.S., it seems like all of a sudden, everyone is expecting a Fed rate hike in June. It's a slight exaggeration, but that certainly is seems like that's how it's playing out. Currently, Fed funds futures are pricing in a 30% chance of a Fed rate hike in June, and that comes from 4% a week ago and 0% a month ago. Now, this all comes about after a number of Fed officials were trotting out, stating that June and July remain possibilities for as months for a Fed rate hike. And I think a lot of this came more into view after the release of the April FOMC minutes, where some of the members were worried that the markets were pricing in, the market was pricing in for a June rate hike was unduly low. Now, we continue to stay with our view for the Fed. We have been looking for a summer rate hike, probably in July, for some time now, followed by another move up in December, and about maybe 3 next year in 2017. But in the meantime, that's sort of how the economies are playing out these days. Still a lot of risks out there, and the ones that come to mind immediately are the June 23rd Brexit vote in the UK, and of course we've got the U.S. elections coming up in November. But once we get through that, we continue to see the Fed gradually moving rates higher, and the Bank of Canada to again stay on hold until the midway mark of 2017. Thank you.